Good morning, everyone, and we at Mehta and Mehta would welcome you all to today's webinar about overseas investment and its impact on the AIF industry. Uh, Much welcome move in the direction of ease of doing business in India. So the webinar will be presented. The presenter for today's webinar is Ms. Shweta. She is a vice president and she heads the compliance and legal division at Multiples. So something about Multiples is that Multiples is a private equity firm. They are highly respected and in the areas of sustainable and successful institution focused on alternate asset investments in India. Something about Ms. Shweta. She has 12 plus years of experience, and at Multiples, her role is to strengthen the governance of the portfolio companies and provide compliance oriented solutions to the business. She's a qualified company secretary. She's a lawyer, and she also holds a PGDM in finance. Her previous working organizations, the organizations which she was earlier associated, are NIIF Infrastructure Finance Limited Company. She was their company secretary and compliance officer. She was also with Aditya Birla Group, Capital Group, and ECM division of Bank of Baroda Capital Markets. She has extensively worked with financial regulators to set up and lead the compliance and secretarial division of the renowned corporates that I just mentioned. And she has developed policies, charters, and SOPs for different business and worked on such complex transactions, right from say fundraising to corporate restructuring assignments. I'm not taking much time. I think I would pass on the floor to Ms. Shweta to take today's presentation ahead and lead us through the same. Thank you.
Good morning to all of you. I have a great pleasure in welcoming you all for this session on behalf of Mehta and Mehta and also on my own behalf. As you are all aware, in the past 1 decade, even rather 5-6 years, we have been actually witnessing enormous growth in the AIF industries. Because we are talking globally, we are talking ease of doing business. We are actually trying to move from criminalized regime to decriminalized regime. And we are also talking harmonization between the Companies Act and the SEBI regulations, etc. All those things we have been talking about it. Government is continuously striving to achieve all this object with the view to ease of doing a business. So what has happened is, in August 22, they came out certain amendments that is actually in line with the Foreign Exchange Management Act of 2015, especially governing the outward investments and their rules, which has been framed by the Government of India very recently. Of course, while framing these rules, because the foreign exchange is involved, the Reserve Bank of India's consultation will also be required, which the government has actually taken on that. So what is happening is, presently any overseas investment, we talk about it, which is to be done by the resident in India, is actually governed the Foreign Exchange Management Transfer of Issue Regulation 2004, and as well as Foreign Exchange Management Acquisition and Transfer of Immovable Property Outside India Rules 2015. But now what happens is, since the business is evolving in India more and more, and increasingly many of the Indian industries are getting integrated with the global industries. So naturally, we are truly aiming to become more globalized regimes. So they thought there is a revision is required in this current existing regulatory requirement, especially in terms of the outbound investment. And they wanted to make in the process a lot of simplification of the existing rules, because today many things are left to the authorized dealer for their interpretation. Certain thing, when we go to authorized dealer, two authorized dealer doesn't give the same opinion, because one authorized dealer says something, other authorized dealer something. One authorized dealer calls for approval, other authorized dealer, though it is all right. All such things have been happening. So what they have done is probably the government is trying to simplify at one end, and they want to align with the current economic dynamic clarity, and also providing what are the various terms really means what. So that is how it has actually come. So more or less what has happened is that we already have the FDI in place. So FDI, there are a lot of things have been there. So the ODA also, we are actually trying in line with the FDI and ODA. And so that, what happens, the related transaction, etc. and other things are all taken. And wherever the relaxation, that means wherever the approval, etc. is there, where approval is really not required, fulfilling with the eligibility criteria alone, without the taking approval, the ease has been actually done. Basically, what is that? Economy is growing, and India is definitely growing now. And we want to do the ease of business. That is the main motive of the government. So really speaking, there are a lot of comprehensive exercise which has been actually taken, the simplification procedure, restriction removal procedure. And you all might have known actually the draft of foreign exchange overseas investment rules, which has been actually put up. It was there in the public domain. They framed the rules, they brought out the things, etc. All those things are there actually. So really speaking, August 22, which is actually now come out with this, will definitely do a new framework, clarifying many things, giving the simplifications and more of ease of doing the business, etc., which will actually help to a greater extent. As Kinjjal said, Shweta has been in this line for quite some time, and she has done the in-depth analysis of the recent regulations, the rules which has actually come with regards to procedural aspects, various terms which are clarified now, and also the reporting requirement. Even the reporting requirement have been reduced to the greater extent here, because they don't want to burden, the typically the regulatory regime, etc., and other things. Because earlier, if you talk about the control, there were ambiguities were there in control. What do you mean by control? Similarly, when you talk about the overseas investment, what is actually the overseas investment? Now clarification has actually come. What really is the overseas investment? What really is the overseas portfolio investment? All the things have been now totally clarified in this latest rules and regulation, which actually has come. So really speaking, I think with these rules, which has actually come here, it is time for us to understand many things before it goes to the implementation. Of course, anything new comes at the stage of the implementation, there will be some problem, there will be some clarification, there will be some notification. All those things will definitely be coming over it. But today, because it is a new rules, new framework, there is a need to understand the whole purpose of this session is actually go through the new regulations and the rules which has been framed and understand the basic idea about that. Today, Shweta will be clarifying to the greater extent. There may be certain cases where notification may be called for, which we may not have the answer. Only time only can tell that once we start implementing it. I think over to Shweta, I will pass on. So with her introductory words, she can pass the presentation. Thank you.
Thank you. Thank you, Bala sir. Thank you, Kinjjal, for the opening remarks and for a very kind introduction of mine. So it's my pleasure to share my views on India's new overseas investment regime. And I really thank you, Mehta and Mehta Advisory, for the kind opportunity. I'm sharing my presentation. Is that visible to everyone?
Yeah, it is.
All right. So as we all know that keeping with the spirit of liberalization and to promote ease of doing business, Central Government of India and RBI have been progressively simplifying procedures and rationalizing rules and regulations under FEMA. And in this direction, a significant step has been taken with the operationalization of new overseas investment regime. So the new overseas rules and regulations were notified on August 22, 2022. And with this new overseas investment regulation, it supersedes the erstwhile FEMA regulation, Foreign Exchange Management, Transfer of Issue of Any Foreign Security Regulation 2004, and Foreign Exchange Management, Acquisition and Transfer of Immovable Property Outside India Regulation 2015. So the updated and RBI has also updated its foreign exchange management directions in line with the rules and regulations. So why we say that it is a step towards promoting ease of doing business and towards simplifying the structure process, but because it actually it clears a lot of procedural aspects, a lot of procedural ambiguity and approval requirements which were there in erstwhile regulations. So if we need to talk about the key takeaways of the substantially deregulated new ODI OPI regime, it introduced a lot of clarity on multiple concepts related to overseas investments. It starts with ODI, definition of ODI, OPI, foreign entity, what is foreign entity, what is Indian entity, strategic sector, control, equity, definition of equity share capital, net worth. So a lot of alignment has happened with the Companies Act, with the FDI, FPI regulation. So that is why we say that it is a major steps towards ease of doing business and simplifying the process. The second very important thing which government has introduced in this new regulation is relaxation on ODI and FDI structure. That means round tripping. It has been rationalized to a certain extent up to the 2 layers of subsidiary. Earlier, it was not at all allowed. I mean, under automatic route, it was not allowed. If you are making any ODI which needs to come back to India as FDI, a mandatory RBI approval was required. But now RBI and government has recognized that because of some practical, business reasons, we may make some ODI which need to come back to India as FDI. So they have taken that into consideration and they have allowed it to a certain extent. Next is general permission for deferred payment of consideration. Now no more approval requirements are there. Even if you're not receiving your payment of consideration on the spot or before sale, before purchase or before sale, that is allowed. That is allowed with some rules and regulation. Next is the pricing guidelines are prescribed for all outbound investment transactions. Earlier it was there, but it was not very clear if there is a transfer from resident to resident of any foreign security, whether pricing guidelines will be applicable or not. Then we were totally on the interpretation of AD. Now they have clarified, and they have also clarified that under what circumstances you will require what kind of valuation. So it is very much clear now. Then the introduction of LSF for reporting delays. Earlier reporting delays, I mean, it used to be considered as a violation, then penalty, condemnation, and all these things route we needed to follow. But now they have introduced a concept of late service fee that is in line with the FDI FPI regulation. So with the minimum late service fee, you can get your reporting delays rectified without mentioning that as a penalty. And the introduction of concept of strategic sector. So as I said, that government has introduced a lot of new definition, that is foreign entity. So what is foreign entity? Foreign entity is any entity which is incorporated outside India, but Indian resident parties or Indian entities or resident individual will be able to invest only when the foreign entity is having a limited liability concept. I mean, Indian resident cannot accept unlimited liability, but with the introduction of concept of strategic sector, if you are investing in a strategic sector, you can expose yourself to unlimited liability. However, this is subject to RBI approval. You cannot directly invest in a strategic sector without taking approval. They've also introduced concepts of or defined debentures, debt, non-debt instruments. However, they have said that it is not permitted for resident individual and for Indian entity, which is not an individual, which is a listed entity or a non-listed entity. They can invest only in such companies' debt where they already have ODI or where they control those companies. And the next is ODI in startup. They have recognized the concept of startup and have permitted making ODI in startup. But however, considering the scarce national resources, they have said that if you need to make ODI in startup, it has to be from your own internal accrual. You cannot borrow money from banks or from anywhere else, and then you can invest in startup. So with certain checks and balances, they have eased out the entire procedural aspects of overseas investment. So now the explaining the broad construct of new overseas investment regime, as I said that overseas investment concept is defined. It is now financial commitment plus OPI, and financial commitment, a major part is ODI. So, and what is ODI? Any investment in unlisted equity capital. It is very much similar to now FDI. So if any foreign entity is making investment in India, what is FDI? If they are making investment in unlisted security, or if they are making investment more than 10% in listed security, then it is FDI. Similarly, what is ODI? If you are making any unlisted equity share investment in any unlisted equity share capital, and if your investment is pursuant to subscription to MOA, or if you are making investment in a listed foreign entity, but if it is equal to or more than 10%, or if your investment is with control, then it is to be considered as ODI. Otherwise, it shall be considered as OPI. And of course, financial commitment also includes debt, but then debt and non-fund based facilities shall only be with respect to those entities where the Indian entity or resident individual has made some ODI. So anyways, resident individual is not allowed to make debt, invest in debt securities externally. So if you have made ODI in a foreign entity, then only you are allowed to have, to grant them loans and make debt investments. So secondly, they have also clarified OPI. In earlier regulation, there was no concept of OPI, though you were allowed, Indian entities were allowed to make investment overseas in listed entity, but there was no procedural clarification that under which bucket it will go, whether it is OPI, whether it is ODI. So these clarity were not there, but now they have very, very, categorically clarified that any investment other than ODI in foreign security, but of course not in unlisted debt instrument, shall be OPI. And one more very important change, which is although not there in the rules, OI rules and OI regulations, it is there in the master direction, which is issued by RBI. So we can infer from that master direction that now investment in units of any regulated investment fund overseas. So if there is a AIF or a mutual fund or any investment fund outside India, whether it is in IFSC or any foreign jurisdiction, it shall be considered as OPI. So even if it is unlisted. So it is a very important change, or a very important clarification which RBI master directions are giving, though it is not there in OI rules and regulation, but we can take it very well from master direction that resident individuals and listed entities can invest in unlisted investment vehicles or unlisted investment funds which are regulated outside India freely under automatic route, provided it should be less than 10% and without any control. So yeah, and they have given very good clarification also that once you have made OPI in a listed company, even if that listed company gets delisted, then also it shall remain as OPI. You will not fall under ODI category. And once if you have made any investment in an unlisted entity which is classified as ODI, it shall also remain ODI even if that unlisted company gets itself listed. So these very small clarifications are also given in these regulations. So now you need not depend on the interpretation of AD, and you need not seek any clarification from RBI, Government of India, for these procedural aspects. So control is defined as control is not just appointing right to appoint directors or having more than 51%. It also means that if you have voting rights of 10% or more in a company, then also it means that you control that company. So once you cross that 10% threshold, your investment shall be considered as ODI. The later part of slide covers that what was overseas investment financial commitment in erstwhile regulation. As you can see that there was no concept of OPI. There was a concept of direct investment outside India, then loans, and then guarantee. And somewhere in different regulation, as per different regulation, you need to fit in the listed entity concept.
Yeah, it was actually earlier, whenever such doubts arises, etc., that we will have to run to the authorized dealer. It is left to the authorized dealer to decide the way he interprets the things. And accordingly, he directs you either you get the approval or seek the clarification, etc. Another thing at all. Now, I think a lot of things have been clarified. So even if we go to the authorized dealer, the interpretation of the all authorized dealer is going to be one and the same. So to that extent, the harmonization has been actually done. As you rightly said, they have brought more in line with the FDI and the ODI in the similar platform. Yeah.
Exactly, exactly. And for the direct investment also, there was a concept of JV, then establishing a wholly owned subsidiary. So it was very cumbersome. So coming to our debt and non-debt instruments, what is debt and non-debt instruments? They have defined this also. It was not previously defined. Definition of non-debt instrument is now aligned with FEMA NDI rules issued for FDI. So it is very much in sync with the FDI FPI regulation. So for debt instrument, what are debt instrument? It is a government bond, corporate bond, securitization structure tranche that are not actually in equity tranche. Then borrowing by firms through loans, depository receipt where the underlying security is a debt security. Debt also includes redeemable debentures and preference share and optionally convertible debenture and preference share. So they have made it very clear that if you have to classify to an equity share capital, it has to be fully compulsorily convertible debentures and preference share. Even if it is a optionally convertible debentures and preference share, it shall come under debt category, where resident individuals are not permitted to invest. Then what is non-debt instrument? It is investment in equity of incorporated entities. Of course, that needs to have limited liability. RBI has very clearly specified that foreign entity shall mean only that entity which is incorporated outside India and which gives limited liability. So it is similar to our company concept that shareholders liability is limited to the exposure they are taking. It is not beyond that. The second is capital participation in LLP. That is also a very, very, welcome move, or I would say a clarification which is given under new OI regulation. Earlier, LLP, capital participation in LLP was a very, subjective term. So whether it will come under equity capital, whether it is allowed, not allowed, what is a net worth for LLP, it was not defined earlier. But now they're saying that capital participation in LLP is actually equivalent to equity, and it is actually a non-debt instrument. Then investment instrument recognized as per FDI policy, investment in units of AIFs, REITs, mutual fund where they invest more than 50% in equity. Then acquisition and sale of dealing directly in immovable property, equity tranche of securitization structure, contribution to trust. Yeah, trust doesn't come to equity of incorporated entity because there they have clearly defined it as public, private, listed, unlisted. So if you are making any contribution to trust, that will also classify in non-debt instrument, and depository receipts issued against any equity instruments. So if you are making any investment in ADR, GDR, that will also be treated as non-debt instrument. So now if we talk about overseas investment by Indian entities. So basically, I have already explained what is debt instrument. Now, if we need to talk about ODI and OPI, so there are a lot of classification that ODI and OPI can be made by Indian entity. Indian entity includes unlisted entity and listed entity. Then ODI, OPI by resident individuals. So, and then by AIFs and all. So taking first overseas investment by Indian entity, that is by listed and unlisted both. So overseas direct investment is allowed. A general permission is given to both listed and unlisted entity. Up to 400% of their net worth, they can invest, they can take over financial commitment in all foreign entity. Up to 400% of net worth, and net worth is now defined as per Companies Act. Earlier it was paid up share capital plus free reserves. Now it is paid up share capital plus all reserves created out of profit and security premium. So this clarification is now given. Earlier there was a different definition of net worth. Now it is aligned with the Companies Act. So you can include your security premium account as well. in
One of
the,
the very good things what they have done actually here, because you know what happened earlier, whenever we used to prepare the financial reports, financial statements, we
yeah,
used to calculate the net worth as per the Companies Act. But
yeah,
when it's come to the FEMA regulations,
yeah,
that doesn't hold good at all,
yeah,
because the definition is different. So we'll have to again recalculate for the net worth for this purpose. Now they have harmonized with the Companies Act, so whatever is taken in the Companies Act as per the audited balance sheet, what Companies Act defines, that will be the net worth for this purpose also. It is a really a very welcome move. It will actually, you know, give a lot of ease to the people. That is
yeah.
one very good move. Yeah, go ahead.
Yes, and they have also defined net worth for LLPs and partnership firm. It was earlier not defined, though logically, if one need to make sense, interpret, they will obviously interpret that for LLP and PF partnership firm, it is capital plus undistributed profit. But since it was not categorically mentioned in RBI regulation, there was ambiguity. Now regulation says that for LLP and partnership firm, net worth is capital plus undistributed profit minus accumulated losses and miscellaneous expenses to the extent not written off. So, so to that extent, it is very much clear. And the prior approval is not required if your investment is up to 400% of your net worth. But if your investment exceeds $1 billion in any financial year, then you need to take, then an Indian entity need to take prior approval, even if it is within the 400% limit. So manner of making investment for Indian entity for ODI, it is specifically for ODI that you can subscribe to MOA, you can make market purchase, you can acquire shares through bidding or tender process, or capitalization. Within capitalization means if you want to convert your loan proceeds or your any other investment in that entity, if you want to convert that to equity share capital, you are allowed to do that. You can also make ODI through rights issue or bonus shares or through swap of securities, which happens through merger, demerger, amalgamation, listing, delisting, or various other corporate events. So this is for ODI by Indian entity. Coming to OPI by Indian entity, it is also allowed, but up to 50% of the net worth of the Indian entity. Net worth definition is common for both ODI and OPI. And listed Indian entity can also invest or reinvest. So reinvestment, RBI master direction actually define what is reinvestment. It is OPI proceeds. It means OPI proceeds are exempted from repatriation provisions as long as such proceeds are reinvested within the specified time frame. So that is allowed. But there are some restrictions on unlisted Indian entity. They can make OPI only by way of rights issue or bonus shares. They cannot make OPI through market purchase or through subscription or through IPO, FPO. That way they cannot make. They can make OPI only by way of rights issue or bonus share or capitalization with specified time or swap of equity share because of merger, demerger, amalgamation, etc. So that restriction is there on unlisted Indian entities. So that is why unlisted Indian entities cannot make investment also freely in overseas investment fund because that is also considered as OPI. But if it is in IFSC, if GIFT City, then there are separate flexibility which is given to everyone, basically listed entity, unlisted entity, and resident individuals. But that is separate. So now coming to overseas investment by resident individuals are now allowed to make overseas direct investment, overseas portfolio investment within the LRS ceiling of $250,000 per annum. So if it is within that limit, they can make that investment freely without taking any approval. But some restrictions in ODI that it is allowed only in operating financial foreign entity. They cannot make investment in a non-operating foreign entity. They cannot make investment in an operating foreign entity which is actually engaged in a financial services activity. So if it is a ODI, as I've already explained, that is investment in an unlisted entity, or if it exceeds 10%, I mean it means 10% threshold, or if you're investing with a control, then it is ODI. But if you are making a ODI, if a resident individual want to make ODI in a foreign entity, that foreign entity should not be engaged in financial services activity. And secondly, even if it is not engaged in financial services activity, resident individuals should not have control in that foreign entity if such foreign entity has any subsidiary or step down subsidiary. So this is one more extra restriction. I mean, it was already there, but now they are put in very clearly that if the resident individual is making any investment overseas, it should not be in FS, financial services. And even if it is not in FS, the resident individual should not have any control in FE if FE means foreign entity, if that FE is having subsidiary or step down subsidiary. So if that is not the case, then the resident individual need to take specific RBI approval. But this restriction is not there in OPI. If a resident individual want to make OPI, it can make OPI in a financial service industry. That is why resident individual is allowed to make investment in overseas investment funds, because that is considered as OPI. So for OPI, there is no such restriction of financial services, non-financial services. It is only for ODI. And apart from this general ODI, OPI, overseas resident individual can make ODI, OPI also through capitalization, rights issue, bonus shares, merger, demerger, I mean swap of share because of merger and demerger, gift as per the condition. There are few conditions which resident individual need to satisfy before accepting any gift. Inheritance, minimum qualification shares, sweat equity share, ESOP. So the exceptions are that even if you are making ODI, that is investing in unlisted equity shares, by way of 5, 6, 7, 8, that is inheritance, minimum qualification shares, sweat equity share, ESOP, you can do it even if the entity is in a FS. Remember, earlier I said that ODI is not allowed if the entity is in FS, financial services. But if it is by way of 5, 6, 7, 8, that is inheritance, minimum qualification shares, sweat equity share, ESOP, then you can do it even if the entity is in FS, or even if the entity has subsidiaries or SDS, that is step down subsidiary, where the resident individual is having control. So this is a move towards ease of business, because inheritance is something that will not come very often. Minimum qualification share is something that you are required to take those shares because you hold a directorship position or a KMP position in that entity. And sweat equity share and ESOP, obviously you get when you are an employee over there. So for these, yeah.
When you talk about the LRS ceiling of $250,000 here,
yeah.
If I think little loudly,
yeah,
this will be a great help for those parents who want to transfer their money for the children who are actually studying abroad. Freely they can use this facility, they can transfer the money in a financial year.
Yeah, but that is for the investment. I mean, parents transferring money to their children is a different concept. That is for the investment limit is to be in is capped till $250,000. So it is basically, I mean, for the overseas investment, if they want to make any investment in a listed entity or an unlisted entity, that should not exceed $250,000 under LRS. If they want to make further investment, they can still do it, but with the RBI.
Here, that means here also the frequency of the investment, there is no restriction, I believe.
Yes, there is no restriction. You're absolutely right.
Only restriction is the ceiling in a financial year. That means April to March. The total ceiling is should not exceed $250,000. But at the same time, as frequency as whatever you decide, that can be done. There is no restriction.
Yes, absolutely right, sir. So frequency is not capped, but the limit is capped. I mean,
only the limit is a cap. Okay, okay.
And for ODI investment, there is a lock-in period of 1 year. If you are making a ODI, you should not divest it within 1 year. So that is another.
Thank you.
Yeah. So exception is one exception which I already explained for 5, 6, 7, 8, and for another exception is that if you are making any overseas investment by way of 6, 7, 8, that is minimum qualification, sweat, and ESOP. If your acquisition is less than 10% in a listed or unlisted without control, then it shall be deemed OPI. So there are lesser reporting requirements for OPI. So that is why if you're acquiring shares in a foreign entity, if a resident individual is acquiring shares in a foreign entity, by way of minimum qualification shares, sweat equity shares, or by way of ESOP, it shall be deemed OPI. So ODI provisions will not be applicable. So this is obviously towards ease of doing business and towards simplifying the procedural aspects. As I already said, the another very major change, which is though not expressly given in the rules and regulation, but coming from master directions, that RIs, resident individual, can make overseas investment in regulated investment fund overseas. I mean, in like AIF or mutual funds or any investment fund, because that shall be treated as OPI.
One more small question I have
Yeah.
on the liberalized remittance scheme.
Yeah.
When we talk about the liberalized remittance scheme, I don't know whether I'm correct or not. If a resident Indian, he actually wants to give a gift, okay, to an international, the international currency, whatever the currency it may be,
yeah,
for another resident person, okay, in the account here outside India.
Yeah.
See, both are resident Indian.
Yeah.
But one is actually in India, one is actually outside India.
Yes. Yes.
But he wants to give a gift in the international currency.
Yes.
Whether it is permitted under NRS scheme.
Yes, yes, it is permitted. So even if it is ODI, OPI, it is permitted.
Okay, okay. Any ceiling limit is there on that?
So it should be under 250. If it exceeds more than that, you need to take approval. It is not that it is denied, but then it will go via approval route.
Okay, okay, okay.
And then there are some conditions that it should be through your relative and all these things. So they have clarified some procedural aspects also for that.
Yeah, yeah. Gift is always for the relatives, so because there's a thing non-relative that will cover differently. But the thing is, only I was thinking resident Indian to the resident Indian in the international currency outside India, whether that is allowed under this NRS scheme. That was my doubt. Yeah.
Yes, that is allowed.
Okay. Go ahead.
Yeah. So coming to the restrictions and prohibitions. So though it ease out a lot of procedural things, there are restrictions. So it prohibits ODI in foreign entities which are engaged in real estate, gambling, and dealing with financial products linked to INR. So, I mean, there are obvious reasons, behind prohibiting such investment, because Government of India and RBI doesn't want to encourage speculations. Because if you're dealing in a financial products which are linked to INR, or if you're making investment overseas for those products, so Master Direction also clarified that dealing with financial products linked to INR will also include investment in foreign stock exchanges, which are linked with Indian markets. So they don't want you to, sorry, yeah.
So one more thing.
Yeah.
When you talked about the link to INR,
yeah,
I'm not talking the current topic, what you're saying.
Yeah.
But when you talk about the linkage, that actually raises a doubt in my mind.
Yeah.
Suppose the remittances is actually made international people, whether it has to be, any convertible foreign currency, or it is necessarily to be only in US dollar. Because what happens is many times we see, especially when it comes to oil, etc., and all the same, the dealing is done only through the US dollar.
Yeah.
Because it is remitted the US dollar, then the things get converted at their end later.
Yes, actually it is in US dollars only.
Yeah. So suppose I don't want to use the US dollar, I want to use the euro currency, or I want to use the Great Britain pound, or I want to use the yen of Japan. Whether this is can be done, because all these currencies are easily convertible now in the liberalized regime.
Yeah.
So whether this can be done, or it is necessarily again linked to only US dollar.
So it actually, the free capital, I mean, it depends on the convertibility. I don't have specific answer to this, but in my view, it needs to be converted into US dollar, and then while coming back to India, I mean, dollar will get converted to Indian rupee.
But I would think rather, the liberalized regime.
Yeah.
It need not be necessarily only US dollar. It can be any foreign currency which is easily convertible. That is what I would actually think. But I don't know.
Okay, because dollar is pegged to all,
I know, because
so that is why,
in fact, for the last 75 years, dollar has been dominating.
Yeah, in couple of our overseas transaction also, we have first converted this
I know that.
to dollar,
Yeah.
and then we converted this to other currency.
In fact, I have a personal experience way back in the year 2007, 8, and 9. I was actually working in the Kingdom of Bahrain. The money used to be paid in dinars actually. But for remitting the money to the India, the dinar has to be converted into dollar first.
Yeah.
Then the dollar will be converted to INR.
Yeah.
And they will be remitting it.
Yes.
Because normally, what happens is, because one thing I don't know whether you are aware or not, in Arab countries, the foreign exchange regulation doesn't take place at all. Whatever happens, the rest of the world, they have a fixed foreign currency. One Bahrain dinar is equal to $3 US. That's all. Simple. No point of time if there is any variation is there. So the moment I get something about the 2,500 dinar or something like that, the moment I go to the bank, it is a simple calculation. 2,500 multiplied by 3, 7,500. So your account will be credited $7,500. Then you talk about the dollar versus INR and then convert.
Yes.
So that used to be the case because everywhere, the US dollar has been dominating it. Now
I think that has not changed. Even if you have to make any remittance outside India, you need to first convert this to dollar and then it will get converted to other currencies. And that's
that is what I thought, because when we are talking so much liberalization, etc., I think it should be, any easily foreign convertible currency rather than necessarily linking up only to the US dollar. That is what I thought. Yeah.
Thanks.
Okay, go ahead.
Yeah. So, as I said, that dealing with
participants can raise any doubts in the chat box. It is already open to you, or even if you want to use your mic, you can also use the mic. You are welcome. Yeah, go ahead.
So dealing with financial products linked to INR actually includes investing in stock exchanges which are linked with or which are connected with Indian markets. So if there is any stock exchange which actually perform in line with or in sync with Indian markets, then also it is not allowed. And second is no FC allowed in financial entity which results in ODI FDI structure. I will not say that actually it is not a restriction and prohibition, because it is actually allowing you to make ODI FDI structure with 2 layers of subsidiary. Yeah, the caveat is that it should not exceed 2 layers of subsidiary, but in earlier regime it was not allowed at all. So though earlier overseas investment regulation did not specifically restrict this ODI FDI structure, but if you read RBI FEMA FAQs, RBI stand was very clear that it doesn't permit round tripping, but now it is permitted, but obviously with the 2 layers of subsidiary. Other some restrictions are that ODI and startup has to be from your own internal accruals only. It has to be from your own funds only. You cannot borrow funds and then invest in startup. And AD Bank need to obtain a statutory auditor certificate of that Indian entity stating that the investment is out of internal accruals and from own funds only. So that is obviously move towards conserve our own resources, so that because startups investment generally is considered as a risky investment. So just to protect that, they have said that you will not borrow funds, you will not take money from banking institutions or NBFCs or from any other company, and then you will make a risky investment. So this is just a explanation to explain ODI FDI structure. You can see the left side is erstwhile provision. Earlier, if you are making any ODI or any overseas investment in a foreign entity, then if that foreign entity need to make FDI in Indian entity, that IE2 is an Indian entity, then RBI approval was required. It was not allowed. So a lot of entities were doing this, but with the specific RBI approval. Now RBI has recognized that sometime it is required that any ODI which is going overseas need to come back in a form of FDI. That is allowed, but obviously they are restricting it, or they want to monitor it by restricting the layers of subsidiary. So if you see the right side, that is a new rule, financial commitment. It says that this is allowed FE from the first scenario, A scenario, it is allowed till FE2, it is allowed till IE2 because it is fitting into 2 layers of subsidiary. But if you need to invest in IE3, that is Indian entity 3, when it crosses the second layer of subsidiary, it is not allowed. You need to take RBI approval. And the B scenario is layers only with Indian subsidiary. So it says that you are making Indian entities making investment in a foreign entity, then foreign entities coming back to India by making investment in Indian entity 2. That is allowed because it is a first layer of subsidiary. That Indian entity 2 is making investment in Indian entity 3. That is also allowed because it is a second layer of subsidiary. But any further investment, any further step down subsidiary is not allowed because it is crossing that 2 layers of subsidiary. So it is for the purpose of keeping an oversight on such investment which are going from India then coming back to India as FDI. So they have allowed, but with certain restrictions. And the pricing guidelines. So pricing guidelines are also notified for all kind of outbound transaction, whether it is from non-resident to resident, from resident to resident, from resident to non-resident. In all sort of outbound transaction, you need to take, you need to follow pricing guidelines. That pricing guidelines, there are only very simple 2 pricing guidelines. That is, it needs to be on arm's length basis, and it needs to be as per internationally accepted pricing methodology. However, they have not defined who will do this valuation, whether a registered valuer, merchant banker, chartered accountant. So that is not clarified. So that we need to wait for AD Bank's clarification on that.
Yeah, that is, you are right actually.
Yeah.
Because what is required to be done and what are the eligibility criteria is there, but who is the person is again, question of interpretation. Maybe some clarification will come on that, I think.
Yes. Or then we need to take guidance from AD Bank.
Correct. That's right.
So AD Bank need to have a board approved policy that what kind of documentation it will take for any, investment, overseas investment. And then pricing guidelines are there are certain exceptions. And if it is a listed security, obviously you need to follow market price. And if it is basis the merger and demerger, whatever swap ratio is defined or agreed, you can follow that. So this was all about overseas investment, new overseas investment regulation. What are the key concept and simplified structures? Now coming to our main topic, that is the implication of these overseas investment on AIF industry. So before I start that, I just thought that I should explain a typical fund structure. How does it look like? And which are the key various parties involved in the fund structure? It is a very simplified basic fund structure, which involves 6 parties. It starts with investors.
One question is actually put, who is eligible to do the valuation? Because as she really said, it is actually international method of the valuation, but the thing is, who is still the question remains actually.
Yeah.
Because that is what we also said. Because today, what is the methodology is to be followed is there, but who is still not clear in this. Probably we'll have to wait for the further notification or circular or clarification on this. Because as of today, there is no answer. Who is eligible to do the valuation? Correct, no, Shweta?
Right. Absolutely right. So we need to take guidance from AD Bank till the time further clarifications are issued by RBI. AD Bank should be able to guide us. So explaining the typical fund structure, it involves a very simple fund structure will involve 6 key parties. That is an investor, sponsor, trustee, fund entity, investment manager, and portfolio companies. So it starts with investors pooling all the money into fund entity. Fund entity is entity which is registered with the regulators, SEBI and IFCA. The investor pool, I mean, what does it do? It pools of all the commitments from investor for investment as per investment strategy, objectives, and fund documents. That is like PPM and the fund documents which we execute with investors. So all the money will come into fund entity. It will have its own bank account and all. But who will manage this money? It is an investment manager. Actually, investment manager is a body corporate or individual who's actually making, managing the entire fund of fund entity. So it is actually, guided by the set of duties and responsibility as per SEBI AIF regulations and IFCA fund management entity regulations. But key point to remember that investment manager is not registered with SEBI. Only a fund entity, a fund gets registration certificate from SEBI. Investment manager is not registered entity with the SEBI. However, it gets regulated by SEBI in the form of code of conduct and investment charter, but it doesn't have any registration certificate. It doesn't need to have any registration certificate with SEBI. But investment manager is a key person which is actually responsible for investment decisions and day-to-day operations and management of the fund entity. So since you have large number of investors, they can't, get themselves involved in the operations of the company. They can't ask various questions and all these things. So it is the duty of a trustee which actually, take care of all these things and authorize investment manager on time-to-time basis on behalf of these investors. So we can say that fund entity is a trust, investors are beneficiary, and trustee is a trustee on behalf of these beneficiary. They authorize a lot of things to investment manager, and investment manager take whatever investment manager does, whether to invest, they evaluate a lot of portfolio companies or the proposed deals, and then whenever they are satisfied, yes, this is a good deal, this is as per the investment objective, fund objective, strategy, they decide that okay, now we need to invest, and then they will invest from the fund. So all the investment shall be made in the name of fund, but investment manager is practically a person who is deciding whether to invest or not invest. And then trustee are the one who are keeping oversight on investment manager entity to just to verify whether investment manager is not exceeding its limits, its powers, and not violating any terms and norms of the fund documents. So trustee keeps that oversight. Then there is a concept of sponsor, which is as per SEBI. There is no concept of sponsor under IFCA guidelines. So sponsor, just to ensure that there is a skin in the game, whatever investment manager is deciding, because this is an investor's money, and investor, they don't have day-to-day, their involvement in the business. Whatever funds are going to a portfolio company, there is some skin in the game of a person which is called sponsor. So sponsor and investment manager can be same. SEBI says that at least 5 CR or 2.5% of the fund size should be invested by sponsor, and it should be there throughout a period of fund, just to ensure that there is some some skin in the investment. Investment manager is when investment manager or sponsor are deciding for any investment, they know that their own money is also involved. However, it is a pretty small amount of fund. So sponsor is responsible for the setup of the fund entity. It need to be a fit and proper person as per SEBI guidelines, and it can be same as the investment manager. Investment manager can also take that sponsor commitment and can become sponsor. But for IFSC guidelines, that is a gift city investment, sponsor concept is not there and it is not required. And last, as I have already explained, that trustee, they have fiduciary responsibility to ensure the best interest of investors who are beneficiaries of the fund. So this is a typical AI fund structure.
There is Subhash Chandra is actually putting a question. Let me read out for you.
Yeah.
Please try to discuss the difficulty that may arise in getting the FCGPR forms filled in. Of late, it has been noticed that a lot of such forms are pending registration with the RBI submitted to the AD. Not many are waiting for the submission on time in the absence of the KFC or credit report of the copies of FIRC, etc. to be issued by the receiving bank in one reason or the other. It takes years to gather to get such issues resolved in the AD and other records. That is one. In relation to the RBI complaints, if there is any chat available with the speaker, presenter, shares some draw alternative to the same, or that we should actually easily refer to in use. My answer to this is actually today's forum, we are not discussing the FCGPR. In fact, in the past, we had a separate discussion of the SP, GPR form filing, etc. Thing. And probably we can share that webinar recording to you. You can go through it. And second thing is you yourself has actually said in the question, it is basically pending because the KYC requirement and the credit report, etc. Other thing. If the eligibility criteria requirement is not fulfilled, then naturally RBI will not get process all these things unless the complete total paper documents is actually in place and the AD actually certified to that. That probably you have to license with the AD and you have to get it actually resolved at your end. Coming to the RBI compliances, I think there is actually a help desk is available actually on the online itself, and there is a designated mail ID is also there. If we actually send the mail ID, I think my experience is by and large, normally they respond within 24 hours and the problem actually get sorted out. Shweta, your views?
Yeah, so yes, absolutely agree with you, Bala sir. And Subhash, we totally hear you and I can relate with you on some of the specific problems which you have mentioned, that in getting FCGPR clearance, and then sometimes because of all these issues, our submission gets delayed and we get late service fee. But it is purely, related to the procedural aspects, and only your AD bank can guide you in that. So, I mean, I totally can relate with the procedural aspects, but yeah, but if there is no fault of yours, and if you have all the, submission, if you have made all the submission in time, there is actually nowadays RBI is waiving off its late service fee. So that window is available, but obviously you need to go via your AD bank only. But that is the leeway which RBI nowadays is giving, that it is waiving off the LSF. In a couple of our companies which I know, RBI has actually waived off the LSF. So that is the one relaxation I have come across with. And second is on the RBI compliances. Since this presentation is for the overseas investment, in my last slide, I have tried to cover what are the various RBI compliances which will get triggered because of the OAI regulation. I've covered it in a slide form, but obviously you need to relate it with the OAI regulations and rules. And as Bala sir said, that there's a helpline available. I mean, you can obviously take that help from that as well. Can I proceed?
Yeah, Shweta, please proceed.
Yeah. So a type of typical fund structure, as I've already explained, there are three types of fund structure AIF. One is standalone, unified, and parallel. So standalone structure is a very basic structure where only one fund will be there, whether it is in India, either in GIFT IFSC or in outside India. They will invest as a fund in Indian portfolio companies. Then a unified fund structure, which involves two funds. One fund will be a feeder fund outside India, whether it may be in a Mauritius or Singapore, or a feeder fund in GIFT IFSC, and that feeder fund will invest in Indian fund, and then Indian fund will make investment in portfolio companies. So in unified structure also, investment in portfolio companies is coming via only one fund, and that fund is getting funds from foreign investment via feeder fund. But in parallel structure, there are two funds which parallelly make investment in Indian portfolio companies. So there is one fund which is there overseas, maybe in Mauritius, Singapore, or any other foreign jurisdiction, or maybe in a GIFT IFSC, GIFT City IFSC. So there are two funds, one overseas and one Indian fund, that is SEBI AIF, and they both are evaluating same deal and investing parallelly in that deal as per the agreed SHA. So these are typical three structures which AIF generally have, and depending on your investment strategy, taxation, and the capital structure requirements and all this thing, generally AIF investment manager decides on which structure they will follow. So now coming to the main thing, that what are the implication of this overseas investment regulation on AIF industry, why we are saying that it is a breakthrough regulation for the AIF industry, because this new OI guidelines open up a new regime for overseas investment for India PE and VC industry by simplifying the existing framework, liberalizing rules of overseas investment, aligning it with the current business and economic requirements, dynamics. And the fourth most important thing is the introduction of framework for overseas investment in IFCA GIFT City, in IFSC GIFT City. So the government is actually has been trying to encourage the asset management industry in GIFT IFSC since a long time. And it started with the operating guidelines for setup of AIF in IFSC by SEBI in October 2018. But then there were a lot of procedural, ambiguity was there. Then government actually strengthened it up by setting up a IFCA, that is a specific regulatory authority for IFSC companies. As a combined and independent regulator in October 2020, IFCA was set up, which has actually thereafter brought a series of amendments, regulations, or exceptions applicable to various regulations. If you are a bank and if you are setting up your banking industry, banking unit in IFSC, or if you are a fund which want to set up AIF industry or a fund entity in IFSC, IFCA introduced a lot of relaxation, a lot of leeway from if you compare the Indian regulations which are applicable to it. And IFCA actually, the IFSC FME regulation actually replaced the SEBI AIF regulation for the fund management entities in IFSC in that center. Earlier, all the fund management which were set up in IFSC, they were also required to be registered with under SEBI AIF regulation. Now IFCA has introduced a new FME regulations for these entities, so they don't need to get SEBI AIF registration. They just need to get themselves registered with IFCA. But all of these efforts were actually restrained by the availability of an automatic route of investment by the investment manager who is residing in India. So earlier, the only permission which was available to the resident Indian party only when it is regulated by, only when if it is registered with Indian regulator. But now these new regulations says that even if you are not registered with the regulator, only just regulated by a financial service regulator in India, then also you can set up your fund entity in IFSC center without having any approval. So as I've already said, that investment managers are never registered with SEBI. They are though regulated by SEBI. SEBI has prescribed code of conduct for them. SEBI has prescribed set of duties for them, but they are not registered with SEBI. So now government has recognized that thing. And now they say that even if you are not registered, only regulated with a financial service regulator, then also you can freely go and establish your own fund fund entity in IFCA or in any overseas jurisdiction without seeking any approval. So that is a very major change which government has introduced for AIF industry. And there were earlier a lot of restrictions under FEMA which required most managers also to apply to RBI for making such investments. Even resident individual was not able to take sponsor title in overseas fund because it was not allowed. But now with the investment from India into IFSC, any person resident in India, whether it is an individual, whether it is a listed entity, whether it is an unlisted entity, they can invest in AIF and that shall be treated as OPI. So that investment is allowed if it is up to 10% or if it is without control. So that is allowed, but for resident individual, it needs to be in the limit of liberalized remittance scheme, that is $250,000 per annum. Then secondly, as I said, that there are various restrictions. If an Indian entity which is engaged in a financial services, if that entity wants to make investment in a foreign entity which is engaged in a financial services, there are three conditions basically. First is net profit needs to be there for 3 years. Earlier it was the Indian entity need to be registered with the financial services. Now they are saying that registration is not required. Even a regulated entity is okay. And the Indian entity is obviously has all the approvals in place to carry out that financial services. So it is a very important change for AIF industry, as the investment manager can now freely set up their fund operations in a foreign jurisdiction or in a IFSC, because that is also considered as a foreign jurisdiction. For IFSC center to promote that GIFT City IFSC, government is saying that if a non-financial services industry, if a non-financial services Indian entity, if that entity is not even, having that 3-year profit track record, then also it can invest in IFSC. So it is not allowed for the other foreign jurisdiction, but to promote IFSC, government has now, clarified, or the new OI regulations now clarify that if the non-financial services Indian entity is not meeting that 3 years profit track record, then also it is okay. I mean, it is under the approval route. And the ease of business by granting approval within 45 days is also a very major change. So now new OI regulation says that first of all, there are various scenarios where you no need to take approval from anyone. Even if you need to take any approval, that shall be either given or rejected within 45 days, or if there is no communication from the regulator, then it shall be deemed approval. So that is also to promote ease of doing business. The next is investment in overseas entities by IFSC fund or entity if IFSC is considered as a foreign jurisdiction. So if there is any investment which is happening from IFSC fund or IFSC center to overseas entity, then it shall be treated as a foreign to foreign investment. So there is no approval required from any of the regulator, whether it is SEBI, RBI. It shall be considered as if Mauritius entity is investing in a Singapore entity. So there is no control of SEBI and RBI. So that is also now permitted. And the last one is that, as I said, that earlier, independent individuals, resident individuals were not allowed to become sponsor without taking approval. But now they are saying that resident individual can become sponsor of a foreign entity in GIFT City. However, there is one restriction which says that if that resident individual is having control in that foreign entity should not have a step down subsidiary or subsidiary outside IFSC. So that is very technical, but yes, it is now allowed. At least a first level is cleared now. So we have talked about IFSC. Now, if you need to talk about SEBI AIF, so now
if we talk about the sponsor,
yeah,
sponsor also actually there is no registration requirement is there.
Yeah.
But at the same time, they have to also, fulfill the conditions of, adhering the code of conduct and their responsibilities, duties, etc. That has been actually spelled out there, although there is no registration as such is there.
Yeah. So SEBI intermediaries regulation actually specify who can be sponsor and who cannot be sponsor, so that there is a fit and proper guidance is there. So if only such entities which are fulfilling those fit and proper criteria, they only can become sponsor.
Correct.
So if you talk about just SEBI registered AIF, so it is now permitted. SEBI registered AIF can invest in unlisted security. It was allowed earlier also, but earlier India connection was required. So if you are investing in a foreign entity, that foreign entity should have any connection with India, or I mean that money should come back to India, or it should have a major subsidiary in India. But now SEBI regulation says that India, they can freely invest in SEBI registered AIF can now freely invest in unlisted entity outside. India connection is not required. However, they have the industry-wide limit of AIF investment is $1.5 billion. And for IFCA AIF, it is permitted under automatic route. As I said, that any investment from IFCA AIF to a foreign jurisdiction shall be considered as a foreign investment, foreign jurisdiction to foreign jurisdiction, where RBI and SEBI has no say. And any investment made by overseas any investment made overseas by AIF shall be considered as OPI, and that is also in wherever we have talked about deemed OPI, whether when resident individual is making investment or Indian entity is making investment, that is being considered as a deemed OPI. Everywhere there was a restriction of 10%, or there was an assumption that it will not exceed 10%. But But if you see Schedule 4, it says notwithstanding of any of the thing which is written here. All investments made by AIF overseas in an unlisted security shall be considered as OPI. So we are taking this interpretation that even if it exceeds 10%, it shall be considered as OPI. Though it is not very, very clearly mentioned, but a logical interpretation is that for AIF, they have given this categorical, exemption that whatever investments they are making, if it is as per their fund documents and if it as per SEBI regulations, it shall be considered as OPI.
I agree with you. You are absolutely correct because the wording which is actually mentioned there, it doesn't talk about any ceiling at all.
Yeah.
And not only that, categorically uses the word notwithstanding anything to the contrary.
Yes.
So
yes.
naturally, your interpretation is absolutely correct. Any investment which is made by the AIF will be considered. Yeah.
Yeah. And as I said, that round tripping is rationalized. They can make ODI, then that ODI can come back to FDI. There is no requirement of taking RBI approval for that if it is not crossing the 2 layers of subsidiary. And in my previous slide also, I have explained that now registration requirement is not the only requirement which is there. Even if you're a regulated entity by SEBI or if by any of the financial service regulator, then there is no approval requirement. So setup of fund management activity outside India for registered as well as regulated entities are now permitted under automatic rule. So if I'm an investment manager in India, and obviously as investment manager, I'm regulated by SEBI but not registered. If I want to set up a fund management business in IFSC or if in any other foreign jurisdiction, I can do it without any approval requirement. And other thing is that clarity on LLP structure is also given. Now, resident individual can become sponsor, LLP can become sponsor, LLP can invest just like that company. It is equivalent to the company. So that clarity is there. It can also become sponsor without any approval requirement. So that is why, it actually opens up a whole new regime. So government is actually trying to serve two purposes. First is that obviously making it easier for AIF industry to invest overseas. And the second very important purpose which is trying to address it is that the promoting IFSC structure, promoting that IFSC in GIFT City. So it's a very major change, a breakthrough change which government has introduced via OI regulation, especially for IFSC, by giving a lot of flexibility and leeway for investment in IFSC. So as I said, that this is my last slide, and it talks about a lot of reporting obligations which are there under OI regulation. And it's completely for the procedural purpose. I have nothing to explain in this. Yeah. I'm happy to take questions. Any?
Yeah, participants, any questions are welcome from you. Because I don't see any questions which are there in the chat box other than on what we actually discussed.
Yeah, I think Binoy has asked that what sort of registration is required for an overseas fund. So if you're talking about overseas fund in an IFSC, then in IFSC, fund investment manager actually will be considered as a fund management entity, and it need to get itself registered with IFSC. And if you're talking about the overseas fund in foreign jurisdiction, then obviously it will be covered by their respective regulation. If it is a US fund, obviously it need to get itself registered with US authorities. But for IFSC, I know that it is with the IFCA, they need to get that FME license.
Neha is actually saying, could you please share the presentation by the email? Neha, for your information, as soon as the seminar gets over, the recorded version along with the presentation is actually available in the YouTube channel. You can actually access it. The link will be made available to your registered mail ID or your registered telephone number, etc. So I don't think you will have any worries on that. And then there is appreciation is coming to Shweta to you from Food Alanda. It's excellent presentation. Thanks for sharing the information. Thank you very much, sir. I can see you. Definitely, I can see your smiling face. Thank you so much, sir, for your compliments.
Yeah. Thanks, Ayush. Thanks.
Webinar is really very
Yeah.
good. That's what Ayush is actually saying. Again, another thanks has come to you. And please also explain process of investment objective fails. Please
Yeah.
explain process if investment objective fails.
So, I mean, I'm not sure if you're talking about AIF perspective or.
I don't know. We can ask. Are you there, Shiv Prakash? Can we hear from you? We are not able to understand exactly what is in your mind. Can you speak? Can you?
Yes, sir. It is, madam, it is like this. Thank you for the opportunity. It is like this that, we invested overseas and investment is allowed up to 400% of the net worth. Now, what if that company purpose is not achieved? There are losses and you need to close the company. What is the reporting requirement with RBI here? Not necessary that every investment will succeed. I made investment, I failed. So for winding up, what do I need to do? Thank you.
Yeah, I mean, it is actually covered in the liquidation process. So it is, so if you have made ODI, if you have set up your own structure over there, then obviously liquidation process is also given. Then you need to follow the host countries regulations. So these are the things. And for AIF, if your fund has not achieved investment objective, then also, I mean, that's at the time of making investment, you need to be sure that you are fulfilling all those criterias. If the investment has failed or if you have not succeeded, then it's a separate thing.
All right, thank you.
Does the AIF have to register and report in foreign assets and liability? 1 minute.
Sorry?
1 minute, let me open the chat box.
Does the AIF have to register and report in foreign assets and liability?
Does the
Yes.
AIF to register,
Yes,
report
yes.
and foreign assets liability?
Yes.
Portal? Yeah,
Earlier
it is
it was
required. It is a
exempt.
requirement.
Yes, there's a FLA requirement is
Yeah,
there.
it is definitely requirement is there. Every year you have to report that. Yeah, that is there.
Yes.
Yeah.
I had another question with respect to ESOPs. So under the erstwhile ODI regulations, consultants and advisors were also permitted to exercise the options which were given by foreign entities. However, I guess this is not permitted under the new ODI regime. So I just wanted to understand in a case that if there is any company which has been recently listed on the stock exchange in the foreign country, and that entity had given certain options to the consultants in India, what is the manner or what are the ways in which these consultants can exercise the options of this foreign entity? Is it permitted? I mean, only the LRS is the route, or can we, do we have any other options available? I'm not able to hear you because you're on mute.
Okay, sorry. So as I said, for ESOP thing by resident individuals, so it is available under, it will be treated as OPI. It shall be treated as deemed OPI. Obviously, if the acquisition is less than 10% in listed or unlisted without control, but yes, it will come under LRS route. It has to follow the LRS seal.
So the only way I can exercise these options, especially in case of consultants, is through the LRS route. I will have to follow all the compliances.
Yeah. So, but there are not many compliances which are there in LRS. So, if it is within $250,000, then obviously you don't need to take specific approval. It is under automatic route. But yeah, LRS reporting you need to make.
Yeah, LRS reporting you have to make so long as within the specified limit there is no approval is required. Actually, it is very easy way of doing it. Actually.
And even if that company is in a FS activity, that also, I mean, even if it is ODI, then also it is permitted.
Okay, and I just had a follow-on question to this. In case I don't exercise the options, as in I don't get the shares of the listed entity, but I just exercise and get the cash, the difference between the grant price and the exercise price, for example. So if that money is remitted into that employee's account in India or that consultant's account in India, are there any reporting requirements or compliances which I will have to follow and do with the AD bank as to how these funds have come into my bank account, or, you know, give explanation to the AD bank?
Okay. I think that explanation may be required, but that then it will not be considered as a overseas investment. So it will not fall under ODI or OPI because you have exercised cash. So it will be treated as your salary income, like your consultancy income.
In fact, either it will be treated as a salary income, or otherwise, I do not know whether it will be, you know, a capital gain or something like that, whatever it is.
That way, yeah.
Yeah, because most probably it will be actually, you know, short-term or long-term capital gain.
Yeah.
That is what it will happen. Any foreign currency which is coming in India, there is always a reporting requirement is there.
Thank you, sir. Thank you, ma'am.
It will not be treated as overseas investment, but it may be.
Yeah, it will definitely, I think, to the greater extent, it will be a capital gain.
Okay, sir. Thank you. Thank you, ma'am.
Any other questions, please? If there are no other questions, I think we can close the session with your permission. I can actually definitely say Shweta has given a very, very excellent presentation with regard to the current new regime framework and the rules and regulations, and explained it very well actually. I must definitely congratulate her and appreciate her efforts to that. And whatever you say, because the proposed simplifications on the overseas investment rules and regulations, coupled with the directions, everything is actually going through in ease of doing the business, and it will no doubt to provide the greater global opportunities and also comprehensive for Indian entrepreneurs to grow actually here. And I have no doubt our Indian economy will have a greater boost, and our global business and brand value, etc., definitely will contribute to the greater extent, especially when we are celebrating our 75th year of independence. Government has been announcing for the last 2 years Amrit Mahotsav festival. Definitely it is a great move for the government in case of the foreign trade. And not only that, it will also create more of the employment, investment opportunity, and give the things, and even the startup entrepreneurs will actually grow. That is what I would say. It's largely good for the country. With these few words, I think we can come. And I think there's one more thanks for your information which has come to you, Shweta. That's all I think so. So thanks a lot to Shweta and also all the participants. With this, I think, Kinjjal, we can close the session.
Thank you, Shweta. It was a very detailed and informative session, as all of us have mentioned. And yeah, thank you, Bala sir. Thank you, Hiral Makwana, for like working and organizing this webinar, and for patiently like working and coordinating with us all. And thank you, audience, for being so patient and listening to her very, very carefully. And we wish you all a very happy holidays, and hope you all enjoy your Christmas Eve tonight, and also the New Year.
In view of the Christmas and the New Year, there won't be any seminar in the next Saturday.
On the next Saturday, yeah, there will.
Yeah, so we'll be meet you only in the year 2023. So I take the opportunity of wishing you Merry Christmas, followed by the Happy New Year. Enjoy your season greetings. Celebrate the New Year. Let us welcome the New Year. We'll meet in the New Year. Thank you.
Yes, yes. Thank you all. Thank you, Shweta. Bye.